Hello traders, James Stanley with StoneX and Forex.com. I'm filling in for John Kicklighter this week for the Markets Week Ahead video, and he often has an intense focus on the fundamentals. I want to take things a little bit differently this week. I'm more of a charts guy, more of a technicals trader, so I want to look at what I think are the 5 charts that matter most for next week. I want to do a quick preview of the economic calendar, the high impact macro events, and then I want to look at the markets that I think could really make a big mark for next week. We had the FOMC rate decision this week, so next week is really going to be all about how that is absorbed, how that is digested. But perhaps more impactful than the Fed rate decision is the alleged Bank of Japan intervention that happened a day later. And this is something that I think is going to have some play through most of the charts that I'm going to look at today. So without further ado, let's get to the chart and start chopping this up. Chart number 1, the US dollar. The reason I want this is because for next week, there's high impact data every day of the week out of the US, and I think that could have a pretty massive pull on what's going on here. Now, at the FOMC rate decision this week, and I covered this in the video on gold last week, it was surprising to me that so many were expecting the Fed to hike. Because if you look at the backdrop, if you look at the fact that Trump spent literally months choosing Jerome Powell's successor, if Kevin Warsh were to go in and hike rates on his second meeting at the Fed, it would have made Trump look really bad. And I could only imagine the social media tirades that we would see in that scenario. Of course, it didn't play. And I think anybody that watched the press conference came away with at least a sense that Kevin Warsh was trying to sound more hawkish than he actually is. This seems like a Fed that does not want to hike rates. But on the other side of that, if Warsh came in and sounded like Kevin has it, talking up rate cuts regardless of inflation levels, then long-term bond yields would have just blown out. So that's some important context, because if we look at the way that the dollar reacted this week, initially it was a pullback to that non-hike. And then it was this move a day later, that Bank of Japan intervention, that really smashed DXY. When we look at DXY now on the weekly, I mean, we could end up seeing a full bearish engulf with a strong potential for continued reversal. Now, prior episodes of BOJ intervention, or intervention around the yen, can lead to follow through, like the rate check that we had in January. Initially, the dollar opened the next week down, sold off aggressively on Tuesday before finding bids into the latter portion of the week, and ultimately ended up rallying. But the one that I really want to harp on in this video is what happened back here in July of 2024, because this one has some spillover effect across the macro landscape. And that's something that I think could have some tie-in. I'm going to get to that in a moment, but for now, USD. USD at this point is testing below the 100 level in DXY. If we close at lows or near lows, this is going to look like it has an open door for a deeper pullback type of setup in DXY. But as to whether or not I think that's going to happen, I think it dials back to another market, dollar yen. So first, before we go further, DXY is a basket. It's a composite of underlying currencies, 57.6% of which is the euro, 13.6% is the Japanese yen. That said, even though the Japanese yen is less than a quarter of the euro's allocation in that DXY basket, it could have far more meaning than the euro. And as a case in point, again, I'm going to draw back to that July 2024 episode. If you look at dollar yen, what makes this so impactful is the fact that it's not just fundamentals that push prices, it's positioning. And if you have a market that is entirely one-sided, heavily long, like we have in dollar yen, and it comes off even a little bit, then that could lead to dollar selling across the board to the point where, like in July of 2024, that dollar weakness could even lift the larger major pair of the euro. But while the dollar is my number one chart for next week, the reason it's number one is because of what's here in number 2. Because the impact in dollar yen could have impact in the dollar, which could then have impact in euro dollar, pound dollar, etc., and then impact in those other markets that are related to that. In dollar yen, there's still a built-in long-term carry trade. there's still massive rate divergence between these two economies. As we had markets pricing in rate hikes out of the US, this once again broke out, went to a fresh 40-year high. When we saw a bit of relief that the Fed did not hike, we had a pullback. But the Bank of Japan didn't like that, because that pullback initially was bid. There's the pullback right there on the FOMC rate decision. You see buyers came in, they pushed it back up. They were essentially looking at this as a buy the dip type of setup ahead of the Bank of Japan rate decision later tonight. That's when this got squashed. You look at this on a short-term chart and this smells very much like intervention, where initially some stops getting run, leading to more supply, lead to a spike, and then this massive candle here right around 9:30 a.m. That smells like intervention in some shape, form, or fashion. I've seen a lot of allegations on social media, and I try not to get too deep into those because who knows what's true. The one that stood out the most to me, that makes sense, but still not validated, is that we had saw a rate check from the US side combined with an intervention from the Japanese side. It makes sense the way this might have priced in as a quick intervention, ran stops, broke down to fresh lows, and then right here, right around the US equity market open, this thing got splashed by a massive sell-off that drove right through 160. 160 wasn't even a speed bump, and that smells like it could have been a rate check, which was the same thing that had sent us spiraling back in January, earlier this year. That was a rate check, or alleged rate check, on Friday, January 23rd. Notice it had follow through for a couple of days until there was a pretty attractive buy the dip type of setup. Now, we're still seeing what this is going to be. The Bank of Japan rate decision later tonight is going to have some pull on this. If the BOJ sounds that they're going to lean a little bit more hawkish in the future, this is something that could give longs even more reason to close, and we could see the sell-off continue. But the reason this matters, the reason this is my second most important chart for next week, is because of what happened right in here. And for this, I got to give a little bit of an explanation. What is the carry trade but a form of global leverage? If you're a pension fund, if you're a hedge fund, if you can go to Japan when central bank rates are near zero or at least closer to zero, borrow capital, and then invest it in a higher yielding economy like the US, there's opportunity in there. The problem at that point is that you're essentially long the yen because you got a loan in Japan from a Japanese bank in Japanese yen. And if the yen is getting just demolished, well, then any gains you might get out of the spread are eviscerated. So what are you going to do? You're a hedge fund. You hedge that risk. You hedge that risk by selling in the marketplace, buying USD, buying euros, buying British pounds, whatever. Anything to get out of the yen. And that's one of the reasons we could get these significant one-sided moves in the currency pair. Now, if you're a retail trader, you probably know the carry trade more as the rollover. You earn rollover at 5 p.m. Eastern time by being long the high yielder, short the low yielder. If you're long the low yielder and short the high yielder, well, then you got to pay. So that can also contribute to this. But really, these moves in a market like dollar yen, it's not driven just by retail traders. It's by that rate divergence. It's by that rate relationship. And ever since U.S. inflation started to tick higher back in 2021, you could see where that's getting priced in. Now, all's good and fine, but like I said, fundamentals aren't a perfect push point for price. The only thing that is buying and selling. And if everybody in a market that wants to be long already is, and there's nobody left to buy, and then you get even the slightest hint or whiff of change, well, now all of a sudden, it's that crowded movie theater. And there's only one exit door, and you start to smell smoke. Are you really going to wait around to see what might happen? Probably not. You're probably going to head for the exits, and that's exactly what happens in an episode like this. This was a BOJ intervention after dollar yen hit 150. Notice it paused the move for a couple weeks. What ultimately drove that reversal was a US CPI report in early November, where markets all of a sudden, longs got the idea, well, maybe the Fed's not going to have to hike as much. And all of a sudden, everybody, or many, wanted to bail, and they did. The fundamentals remained long and strong, and so after the pullback, bulls get right back on the bid, drive it right back up to that same prior price. Again, November of 23, below expected US CPI report. Hey, maybe things are going to change. Trade's pretty crowded. You get unwind. But April of 24, U.S. inflation remained high. Those rate cuts that the Fed had been forecasting for later in 24, they didn't seem so likely. All of a sudden, now the stops that we're setting Above that prior high are rocket fuel. As this breaks out, runs all the way up to 160. 160, the BOJ is like, uh-oh. They intervene again. This is important. They intervene at 160, a brief pullback until this hits 150, 195, support or prior resistance, and then bulls just get right back on the bid. This is the one that I wanted to harp on, though. July 11th, 2024. It was the morning of a US CPI report. At that point, the BOJ had intervened here, failed, essentially just lit cash on fire. But right here, dollar yen gets back above 160. It was almost like they were kind of unnerved by the whole matter. So this time, they were strategic with their intervention. The morning of Thursday, July 11th was a US CPI report. And again, it was US CPI that drove this breakout on April 10th. Just like it had driven pullbacks in November of 23, November of 24. That US CPI report, that inflation data, it's important because it speaks to Fed policy, rate expectations, which are what these market participants are following to see as to whether or not they should hold their hedges. Morning of Thursday, July 11th. Below expected US CPI report, and the BOJ was ready to intervene. So it was like a 1-2 punch. And so longs all of a sudden got scared out of the trade with the intervention, and then the below expected CPI made it look as though maybe the Fed is actually going to be able to cut. And before you know it, this thing is spinning upside down, spiraling lower. But this is what leads to chart 3. I'm not done with chart 2, but let's take a quick look at chart 3. This is the Nasdaq 100. So quick little preview is what we'll be looking at. You look at the Nasdaq 100 on the morning of Thursday, July 11th. Right there. See, initially it set a fresh ATH at the time. Briefly. But as that dollar yen carry trade unwound, so too did the Nasdaq 100. At the time, we had the high-flying AI tech stock scenario that's still in place today. But why did it come off so quickly? Well, because the carry trade is but a form of global leverage. It didn't take long, but you started to see major magazines and newspapers pointing to the Bank of Japan as being the reason why tech stocks had started to sell off. The morning of Thursday, August 5th, right here, when the Nasdaq bottomed at the time, we had the third highest ever spike in the VIX index. There's a relationship between these matters. It might not be lockstep, it might not be perfect, but if we see dollar yen coming off with aggression, that could lead to a global deleveraging event that could spill into equities, could spill into bonds. It could have impact across other markets. Right now, we know that the US side wants to see a weaker dollar. We know that the Bank of Japan would like to see, and the Ministry of Finance would like to see, a weaker dollar yen spot quote, but they don't really want to raise rates. They don't want to fix that fundamental divergence that would actually create that outcome. So this might even be the most important chart for next week, but the repercussions of this can be massive. For now, it's a pullback. I want to look at this chart longer term to get a couple of zones that I think matter. At this point, we have support showing up at a familiar spot, prior resistance right around 158. Below that, 154.90, 154.49, 154.45, up to 155. That's a huge zone if we do get a deeper pullback type of scenario. And then right down here, 151.95, it's that same high from 22, 23, up to around 152.08. That's my S3 zone for deeper pullback types of plays. If we get dollar yen back above 160, this intervention is going to start to smell as though it had failed. That reopens the door for a retest 161.95, 162.95, and then that 164 handle where it stalled this week. Above that, 165 is the big figure. And if we see 165, I think you're going to get another form of intervention. I said this in the Tuesday webinar. I was going to be surprised if the Japanese side didn't handle this as it got closer to 165. And obviously, it appears though they did. Chart number 3, the Nasdaq 100. We've had a lot of tech earnings reports, and the response so far hasn't been great, but we've seen some change. Now, I think this boils back to Fed policy to a degree, because if you look at the way that the Nasdaq 100 traded since that June 17th FOMC rate decision, we lower high, and then the sell-off started to take hold. I'm still of the mind that this is a bullish setup until it absolutely is screaming in the other direction, and it's not there yet. I'm looking at this from the weekly chart. If this weekly bar closes in the green, especially if it closes near the highs, that's a hammer formation. That's an attractive bullish backdrop, in my opinion. I'm looking for that to lead to a deeper bounce back up towards a 29, maybe even deeper. But 29084 is that next Fibonacci level that I have. And then right in here, right around 30K, that's a big, big spot. But you can see we had a bullish engulf on the daily right around that Japanese yen intervention. And I think something that could be supported, especially if we close the weekly bar in the manner, well, that we can, if it closes in as a hammer. Now, if we close below this level, 27,914, it's going to continue to carry some of that bearish appeal. Given that we saw a Warsh walk back from rate hikes, it's not something that I'm looking at as a base case now, but if we do close below that, that keeps the door up for a retest of this level. This level was a clean little technically a double top that didn't continue filling in. It did break, but didn't go to target. But it was a double top right around 26K. Massive spot. But given the way that we've seen tech stocks selling off, even around some not terrible earnings reports. I mean, you go back to the Google earnings report Wednesday before last, and that response, I think, is showing that the market has a differing opinion around all this CapEx spend on AI. You know, Google had that first negative cash flow in a very long time, at least. And the response here, pretty massive. But it's all about how that weekly bar closes. If it closes in the green, if it closes as a hammer, I'm looking at that as bullish. Chart number 4, long yields. So one of the big items that I think a lot of traders that have started in the last 20 years or so might not give credit to is just how important bonds could be to an individual investor's portfolio. Like when I was learning equities, when I was learning trading in the late 90s, early aughts, it was all about asset allocation. And if you had the opportunity to get 7% locked up, fairly low risk in treasuries, or even, you know, as they say in a 90-day T-bill, a risk-free rate of return, you know, at a 5 or a 6%, that's a compelling opportunity cost. But when you have yields diving in below 5%, it's not all that attractive to lock up your capital for 30 years, you know, especially if you're looking at maybe a real rate of return of 2, maybe 1%. Not that attractive. And I think that was one of the features, and not a bug, of QE. But that's changing. That's shifting. This week we had fresh 19-year high 30-year yields. It's neither here nor there yet, but if you look at what ultimately turned the tech bust or tech boom into the tech bust, it was this episode, right? When we had these declining yields in the back half of the 90s, that's what ultimately drove more and more capital into tech stocks. I mean, there was less and less opportunity by locking up capital at 7 or 7.5% in 30-year treasury. So more reason to bid the dip in a .com name. But right in here, we had a low at like 4.7% in 1998 that spiked up to a 6.7% in early 2000. At that point, now there's all of a sudden an opportunity cost. There's a viable area to look to as an alternative to buying the dip or the pullback in those tech names. And that's one of the things that helped the tech boom become the bust. An attractive spot to park capital in long-term treasuries. Now, if you're parked in at just say 6.5% in 30-year bonds, you can clip those coupons for the next 30 years. Or if yields go down, prices go up. Now you're setting in a principal pop in that bond, and you could close it at a capital gain. It becomes a pretty attractive trade. And then if you see something like we had in the financial collapse where yields spike down, well, the value of that 6.5% coupon is even more. And so while you have this rescission in yields, you have a bull market in bond prices. Now it's going in the other direction. As you get this threat of a breakout, there's even less reason to be holding long bonds. And this is something that could have ramifications across the macro landscape. Now, the 10-year is what is often followed or looked at as the benchmark. But long bonds, this is what has relationship to mortgage prices. And mortgage rates, I think, were at their highest in 19 years this week on the basis of this breakout in the 30. This is chart number 4. It could have some massive connotations for next week. Chart number 5. This one's a lot messier, in my opinion, but it's one that I think has a lot of relationship across markets. And it's oil. It's purely around the continued scenario in Iran. We had oil prices spike and matters were pretty worrying a week ago. They stalled right at that resistance at like 93.26 to 95. They since pulled back. You can see we're kind of in the middle of that move right now, so there's still a lot left to be decided. But the reason that I think this is so important is because if we do get more tension around Iran, and if we do see this resistance zone get taken out, if we do see yields, oil prices go above 100, that's something that could have a knock-on effect, not only on yields, but on the dollar, on dollar yen, on equities. I think this could take the show in that scenario if we do see oil prices jump. And it's something, obviously, I think that Trump doesn't want to see happen, but it's also something that increasingly may be out of his control. But I wanted to leave this as chart 5 because this is the one that, like I said, it could end up stealing the show based on the way that things go. But that, my friends, is what I have for that this week. That's what I'm looking at for next week. And those are my 5 charts that I think are most important for right now. As always, thank you for your time. Happy trading, ladies and gentlemen.